The debt is not a constraint. In fact, aggregate demand is not going to be that much of a constraint. So it's all really about the political economy, like it or not. I don't want to play politics either, but like it or not, political economy is what's going to determine how much of an investment agenda we can have.
Thanks. So
Paul's much more confident that aggregate demand and concerns about financial stability are not going to be an important issue by the end of the year, given a program of this magnitude, than I am. He might be right, but he's much more confident of that than I am. I kind of agree with him. If you had asked me to make the case that I was wrong, I would have used the same example he did of 1994, where you did have a big interest rate spike, and you didn't have adverse economic consequences. I think the big difference between that environment and this one is that in 1994, we had a government that was organized around the theme of fiscal stability, deficit reduction, and bringing down the debt share of GDP. And a similar kind of scenario in an environment of double-digit budget deficits, it seems to me would carry with it substantially more risks than what we had in 1994. There may be a difference between Paul and I in the extent to which one wants to make the best be the enemy of the good. I think in terms of economic analysis, the way we can make the biggest contributions is by warning about what the risks are, and by being clear about what would be the best opportunities. And it doesn't sound to me like Paul disagrees with me that if we did what was necessary to fight COVID, to remove schools and to get schools going, and then we did what was necessary to meet that $20 billion a month in lost wage and salary income, and beyond that, we focused heavily on public investment, that would be a better approach to meeting the needs of the moment. I think where we differ is that he's more optimistic than I am that on the path we're following, we'll get to more or less the same place with some non-optimal policy and some groundwork laid that will make the public investment more likely. He's more optimistic that this will prove to have been a very successful political route to getting to that than I am. But on the fundamental economic analysis, I think what I've found encouraging is that we have fairly similar views.
Thanks. So let me just move a little bit also to monetary policy as well, and Paul perhaps can elaborate on that. So you both argued actually that the central bank independence is not so important anymore, but this was under a time where we had fiscal constraint, fiscal austerity in many, many countries in the world. Would you still saying to manage the risk which might come along with the stimulus, do you think now central bank independence is more important again? So that because you have now, of course, I agree that you have a high debt burden, a debt level, but with a low interest rate, the debt burden is not so high. So how do you see this? On the one hand, the debt burden for the government is not so high because the interest rate is so low, but there might be also less room for the central bank to move, or more political pressure. How important is central bank independence these days? Did it become more important now with this debate, or do you think it's still not so important?
Okay. Actually, I just want to make one more point, which I forgot to make earlier. I didn't, which is that in this program, there is a fairly large role partially implicit of automatic stabilizers. That if the economy does really well, first of all, the unemployment insurance outlays will come down, so that that component will be substantially smaller than is now being projected. And also, although this is the implicit part, if the state and local fiscal situation is substantially better than we expect, I think that they will bank a large part of the aid, so that the downside, if the economy has an upside, then that in fact is going to probably reduce the amount of stimulus that's going to be supplied. So I think that's worth saying. About, yeah, central bank, I think it's, there was a reason why central bank independence became a kind of a talisman, which was that we had a period of at least where it was perceived that inflationary psychology and political dominance over central banks led to bad stuff. And you can certainly see that to some extent in Arthur Burns, and you can see that the dash for growth in Britain and all of that stuff. And so we got to this position of central bank independence being crucial, and then, that was actually a response to an inflationary environment of that's long gone. Now, there is a question, if we're saying, okay, actually a lot of bad stuff happened as a result of central bank independence, it would be kind of a shame if we ditched it exactly as we approach the moment where actually the case for central bank independence is coming back. It would be, we would be managing always to be fighting the last war economically. I think we're quite a ways from that. The thing is that it took years. You don't unhinge expectations that quickly. It's not the case. It's simply, in fact, it's not the case that the moment that LBJ decided to have both guns and butter, that inflation expectations ran wild. It was years and years of bad policy judgment. And I don't really have any worry that the current US administration is going to try to bully the Federal Reserve into accommodating its fiscal policies. Who knows, what may follow, but God knows if we have another administration like the one that just left, I think central bank independence is going to be the least of our concerns, and it wouldn't persist anyway. So I just don't think that that's such a. I think that's an issue that we microeconomists tend to make a big deal, tend to regard, particularly because particularly macroeconomists of a certain age, with Larry and me we remember the 70s, but I don't think we should be all that obsessed about the question of central bank independence, not yet. Much more, if there are concerns, they are the ones Larry is raising, which is that this is a really big fiscal package, and not to worry that Jay Powell is going to try and make it disappear or inflate it away.
Thanks. So let me throw this question also to Larry, but also combine it with an earlier theme Charles Goodhart put out in this webinar series, and he also wrote a book on. He argues that the low inflation, real interest rate era is over, which is very contradictory to Larry's secular stagnation. But he argues one reason inflation was so low was essentially that there was a huge labor force in China and Eastern Europe joining the global workforce. And that brought inflation rates down. It really put pressure on the trade unions and others, so the wage bargaining changed. And he argues, at least Charles Goodhart argues, this pressure will go away, and hence the low inflation era will not persist. Do you share these concerns at all? I think that's probably a much more long-run perspective. Your worries right now are, I guess, much more short-run concerns.
Look, I'm kind of under sort of the influence of a couple things. When I was in graduate school in my early years as a professor, the liquidity trap and zero interest rates was kind of an interesting historical thing that didn't seem terribly relevant to today's to the world of today. And then it became central. And I learned from that things have a way of coming back. And so I think there's a current generation of economists that finds, after 40 years of basically low inflation, where the inflation rate basically hasn't changed importantly in a generation and a half, it follows that any right-hand side variable is going to have a zero coefficient, predicting a dependent variable that doesn't move. And so what